with some business basics. First, let's talk about the different forms that a business organization can take. So we're actually talking about the specific entity type that you might be as a business. One is a sole proprietorship. This is your most basic form of business organization. It's your easiest to form as well. You have an idea for a business, you start up, maybe, if you're in the city or the county, you get a business license to operate, but other than that, you can just start operations. You are the business owner, the owner and operator probably of the business. That's why we call it a sole proprietorship. And so you just start doing whatever it is you're doing, providing your service or your products for sale. There are some positives and some negatives with being a sole proprietorship. You are your own boss. You can set your own time. You also are the sole recipient of all the profits of the business. However, you're also the sole person responsible if the business has losses, and you suffer because of those as well. You have something called unlimited liability as a sole proprietorship. This means that you are personally liable for all of the debts of the business. You could be held personally responsible for things that would go wrong. Someone, say, sued your business. They could come after your personal assets as well as business assets. So that can be a big disadvantage. Also, you're the only person that is available for financing or capital injections as far as cash is required or needed. So if you want to expand or if you needed financing to start the business or to increase your business, you're the only person you really have to look to for those types of resources. So you may have to look for outside sources a little bit more frequently. You could just be, independently wealthy, and then that would work great. You also have a limited life as a sole proprietor. The life rests with you, whether you physically are alive or you want to continue the business. If you decide you want to retire, then the business no longer exists. Or if you decide, well, maybe not decide, but if you cease to exist, then the business itself also ceases to exist. So there is a limited life. Also, you have tax implications with a sole proprietorship. This is a form of business that the profit or loss of the business will flow through to the individual. So you don't actually file a separate tax return for a sole proprietor. You would just put it on a Schedule C of your individual tax return, be another page kind of your tax return that you would send in. It would be taxed at your rate, but you'll also get taxed self-employment taxes as well. So there's some goods and there's some bads, okay, of the sole proprietorship. Let's look at the next type of entity that you might be, which is a partnership. And as the name implies, you have to have at least 2 people to form a partnership. Now, you could have 50 people if you wanted to. Could be very interesting partner meetings. Might not make decisions very easily, but you could, or you could have all the way down to 2, okay? No less than 2, but certainly can have more. So partnership, again, has some advantages and some disadvantages. You now have more resources to pull from. And again, when we talk about resources, we're not just talking about financing options or cash that you need to run or to begin or expand a business, but also resources in the sense of you have other people that are good at different things as well. Now, let's say that you love to bake. You want to open a bakery, but you really don't know that much about business, the business side, or accounting, for instance. Hopefully after this class you'll know some more. So let's say that you have a friend that's an excellent accountant and they don't know how to cook anything. Okay, certainly don't know how to bake. But you know how to bake everything and are fantastic at it. Well, guess what? You could form a partnership. You could do all the baking, they could do all the business. So we're not just talking about funds, although that can be something that's discussed, but also other resources. You can pull those resources to the best advantage of the whole. Partnership does have limited life in the partnership organization. For instance, if you took on a new partner or you sold a partnership interest to someone else, then the partnership would still continue. I mean, it would still be open for business, but the actual organization of the partnership would need to change to reflect those different owners. So that kind of still lends itself to that limited life that we talked about before. Tax implications for a partnership. The partnership actually does send in a tax return, but it's for information only. What happens is that tax return gets split up, either the profit or loss, again, gets split between the partner's shares. Oh, and I'm sorry, you might hear a little background noise in this. There's a train going by where I am, where I'm recording, so just a little bit extra for you. But however the partners have decided they're going to share, when you form a partnership, you would also create a partnership agreement that would state how you share in the profits and losses and how you operate the business, who's responsible for what things as well. So however you've decided to share in profits and losses, that's what would come through on your individual tax returns. You would get a piece of paper that says, hey, you get, this much money that you need to report on your income taxes for your partnership share. And so you would carry that forward or carry it through to your tax return, and it would be taxed at your individual rate for each specific partner. As far as organizing a partnership, it's not quite as easy as a sole proprietor. You do have to have a partnership agreement, or you should, and you have to actually form as a partnership. So a little bit more complex than a sole proprietor. Third type of entity is a corporation. Oh, you know what? Before we go to corporation, let me mention one thing that I forgot in the partnership. There is a special type of partnership that's called actually an LLP, a limited liability partnership. It's a special type where some of the partners actually don't have that unlimited liability. Partnerships also have unlimited liability like the sole proprietor did. They're personally liable. But if you have a LLP, a limited liability partnership, then limited partners have limited liability. So they're not responsible personally for anything. Only what they have invested in the business is what they could risk losing. However, that does come at a price. If you are a limited partner, that means you cannot have anything to do with the day-to-day operations and management of the business. If you want to have a say in the day-to-day operations and management, then you would be what we refer to as a general partner. And general partners have unlimited liability. Now, on to the corporation. Corporation is the third type. It's the most difficult to organize. It doesn't mean that it is super difficult, but it is the most difficult to organize. You have to file formal articles of incorporation with the state, have bylaws, all these types of things. When you have incorporated with a state. Now, corporations are like a separate, or not like, they are a separate legal entity. So they're like an imaginary person, I guess you could say. Corporations make contracts in their own name, they buy assets in their own name, they enter into liabilities or debts in their own name. So they are taxed as a separate entity unto themselves. They send in a tax return that is taxed at a separate corporate rate, which is usually higher than individual rates. Corporations, the owners of a corporation are shareholders. Corporation is unique that it has shares that are sold, that's pieces of ownership, and it's easier for a corporation to raise funds that way because they can sell ownership in the company easily with these shares. Easily to transfer, that means that it has an unlimited life. If a shareholder dies, it does not mean that the company has to now reform. We can just transfer that ownership to someone else. So unlimited liability, unlimited life. Corporation does have a big disadvantage with the taxes though, because they suffer a double taxation. They're taxed once for their profits or losses, and then if they give anything back to their owners, their shareholders, something like that's called a dividend that we'll talk about later. Hey, thanks for investing with us, we want to give you something back. Those are taxed again at the individual rate of the owners. So that's actually taxed twice. Now, don't confuse that. The owners don't take profits and losses of the corporation onto their individual return. The corporation pays for the profits or reports in the losses in a separate tax return because they're a separate entire legal entity unto themselves. Corporation called an S corp, an S corporation, and this is kind of a hybrid between a corporation and a partnership in that you can only have 100 shareholders and they have to all be domestic, no foreign investors. But an S corp gets the tax advantage like a partnership, but the limited liability of a corporation. So it's a kind of a hybrid in between those two. Financial information. Who uses it? What is it? What do we do with it? Well, we have two basic users, internal and external. If you're an internal user, you are internal to the company. So think of the people inside a company. Your board of directors, if you're a corporation. These are the people that your shareholders, your owners elect to put the president in place, and the CEO and the CFO, and kind of oversee the corporation. Your management team, those people we just named, your president, your CFO, your CEO, that's chief executive officer and chief financial officer, your employees, anyone that's inside the company, internal users, they all need information to help make decisions and help run the company. The information they need is a little different than the information that someone outside of the company would need, an external user. If you're outside of the company, so let's say that you're a customer, or you're an investor, or a creditor even, a bank, a governmental agency, all of these people would be external users. The information that you need would be different perhaps than an internal user. So we need to know who you are as to how I need to make information, build information and reports to best fit your needs and what you need to see. Based on that, we can design a good accounting system around that. Ethics also has an important place in this and has placed more requirements and regulations. So the Sarbanes-Oxley Act, which is referred to as SOX, S-O-X, was passed because of a lot of fraud that happened in the accounting world. And so this tightened some financial requirements and made management more responsible as well for things that were given out in their financial information. Financial statements themselves are the end result. These are the things that we're trying to create for our users. So accounting is the language of business that gets us these financial statements so that our users can have some way to tie in these numbers into a usable format. We'll talk about what these specific financial statements are in another segment. Now, let me briefly also mention the types of businesses. Now, not entity type, but what could you do as a business? Well, you could be a service business. Okay, you actually provide a service, something that is intangible. So a doctor, for instance, would be a service business, or a merchandising business. So this is someone that purchases a product and resells it. So, you know, Target, for instance, would be an example of a merchandising firm. One other type is a manufacturing firm. This is where you take raw materials or component parts and you create a finished good. So you manufacture, you make something yourself. It's still a tangible product. Now these three and the first three that we talked about, your forms of organization, can intermingle. You could have a sole proprietor that's a service business. You could have a sole proprietor that's a manufacturing firm, or a sole proprietor that's a merchandising firm. So these are just two different kind of pots that you're pulling from. It doesn't mean that one has to be exclusive of the other. This just shows you different types of business that we could be doing, and because of that, you're going to see that our accounting will be a little bit different for some of these different types as well as we go through the semester.